In 2001, Enron Corporation was ranked the seventh largest company in America. It had over 20,000 employees. Its stock had soared to $90 a share. Wall Street loved it. The press called it a revolution. And then, in less than a year, it was gone. What happened inside Enron was not just a business failure. It was one of the most calculated, coordinated financial frauds in American history. Enron started in 1985 as a modest natural gas pipeline company based in Houston, Texas. Its founder, Kenneth Lay, had a vision: transform a boring utility company into an energy trading powerhouse. And for a while, it worked. Under Lay and his hand-picked CEO, Jeffrey Skilling, Enron reinvented itself, not as a company that moved gas through pipes, but as a company that traded energy contracts, broadband, even weather futures. It was aggressive, it was creative, it was Wall Street's darling. By 2000, Enron reported revenues of over $100 billion. Fortune magazine named it America's most innovative company, 6 years in a row. But the foundation of Enron's success was built on a single accounting trick, one that would eventually destroy it. In the early 1990s, Jeffrey Skilling convinced the Securities and Exchange Commission to allow Enron to use mark-to-market accounting. The idea sounds reasonable on paper. Instead of recording profit when cash actually comes in, you record the estimated future value of a contract the moment you sign it. For a legitimate company, this is aggressive but defensible. For Enron, it was a license to print imaginary money. Here's how it worked. Enron would sign a 20-year energy contract. On the day of signing, it would estimate the total future profit, say $500 million, and book that entire amount as revenue immediately. The cash hadn't arrived. The profit hadn't been earned. But on paper, Enron looked spectacularly profitable. And because the estimates were made internally by the same people whose bonuses depended on those numbers, there was no real check on the fantasy. Every year, Enron needed the numbers to look bigger than the year before. So the estimates kept growing, the contracts kept multiplying, and the gap between the fiction on paper and the reality underneath kept widening. But mark-to-market alone wasn't enough to hide the rot. Enron's finance team, led by Chief Financial Officer Andrew Fastow, had built a web of offshore companies, special-purpose entities, designed to hide debt and manufacture earnings. The scheme was staggering in its complexity. Fastow created hundreds of shell companies, many named after Star Wars characters: Jedi, Chuko, Raptor. These entities would take on Enron's bad assets, keeping them off the balance sheet. Enron would then book fake profits from transactions with its own subsidiaries. It was accounting fiction, written in billions of dollars. And the auditors at Arthur Andersen, one of the most respected accounting firms in the world, signed off on it. Fastow himself collected over $30 million in secret fees from the partnerships he was supposed to be managing on Enron's behalf. He wasn't just hiding the fraud, he was profiting from it personally, at the expense of the company he worked for. Inside Enron, the culture was ruthless. Skilling had introduced what employees called the rank and yank system. Every year, the bottom 15% of performers were fired. It bred fear. It rewarded aggression. It punished questions. Traders boasted about manipulating California's electricity market, deliberately causing blackouts to drive up prices. They had nicknames for their schemes: Death Star, Fat Boy, Get Shorty. One recorded phone call captured Enron traders laughing as wildfires spread across California, because it was cutting power supply and boosting their profits. The greed was not just tolerated, it was celebrated. The most visible damage Enron caused, before anyone knew the full extent of the fraud, was in California. In 2000 and 2001, California had deregulated its electricity market. Enron saw the opportunity immediately. Traders would deliberately overload transmission lines, then get paid by the grid operator to relieve the congestion they had just created. They would withhold power from the market during peak demand, creating artificial scarcity, and then sell it back at 10 times the normal price. Rolling blackouts hit hospitals, schools closed, businesses shut down. California's electricity bills went from $7 billion a year to $27 billion in a single year. Enron made hundreds of millions from the crisis it engineered. The people running those schemes were in their 20s. They were celebrated inside the company. They were getting million-dollar bonuses for causing suffering to millions of ordinary people. And they knew exactly what they were doing. While Enron's executives were selling their shares, quietly, steadily, before anyone outside knew the truth, ordinary employees were being actively encouraged to buy more. Enron's 401k retirement plan was heavily loaded with company stock. And in October 2001, just as the company's situation was becoming desperate, Enron locked the retirement accounts. Employees could not sell. They could not move their money. For 30 days, workers watched their retirement savings collapse in real time and could do nothing. When the lockdown lifted, Enron stock was already in freefall. Workers who had spent 30 years building a nest egg woke up to find it was worth nothing. Some lost everything. One employee testified before Congress that she had saved over $300,000 for retirement. After the collapse, she had $4,500 left. In August 2001, Skilling suddenly resigned, citing personal reasons. It was a red flag few caught in time. Then in October, Enron disclosed a $618 million loss and revealed it was under investigation by the SEC. The stock began to crater. A whistleblower, Vice President Sharon Watkins, had already sent a memo to Kenneth Lay warning that Enron was about to implode in a wave of accounting scandals. Nobody listened. In fact, Enron's own lawyers advised Kenneth Lay that he had no legal obligation to act on Watkins' memo, and so he didn't. By December 2, 2001, Enron filed for bankruptcy, the largest in U.S. history at the time. 20,000 employees lost their jobs almost overnight. The stock that once hit $90 a share was now worth pennies. The investigations that followed were brutal. Jeffrey Skilling was convicted of fraud and conspiracy in 2006. Sentenced to 24 years in prison. He served 12. Andrew Fastow pleaded guilty to securities fraud and conspiracy. He cooperated with prosecutors and served 6 years. Kenneth Lay was convicted on all counts in 2006. But before he could be sentenced, he died of a heart attack at his vacation home in Colorado. His conviction was posthumously vacated. Arthur Andersen, the auditing firm that looked the other way, was indicted, convicted of obstruction of justice, and collapsed. 85,000 employees worldwide lost their jobs. The Enron scandal rewrote American corporate law. It led directly to the Sarbanes-Oxley Act of 2002, sweeping new regulations requiring CEO and CFO accountability for financial statements. It separated auditing firms from consulting work. It created criminal penalties for executives who signed off on false financial reports. It was the most significant overhaul of U.S. corporate governance in 70 years. Enron's executives didn't steal from a vault. They stole from trust, the trust of employees, investors, regulators, and the American public. They built a machine designed to look like a company while secretly hollowing it out from within. What makes Enron different from most corporate frauds is the scale of the self-deception inside it. Many of the people who worked there genuinely believed in what they were building, right up until the moment it collapsed. They had been told they were the smartest people in the room, and they believed it. That may be the most dangerous thing about Enron. Not the greed, not the fraud, but the complete and total conviction that the rules didn't apply to them. And when it finally fell, it took everything with it. The biggest lie in American business history. Told by the people who were supposed to be the smartest in the room.